Personal finance practice problem using OneNote. Coupon rate, current yield, yield to maturity, and market price for bond issued at a premium. Prepare to get financially fit by practicing personal finance. You're not required to, but if you have access to OneNote, would like to follow along, we're in the icon left-hand side, Practice Problems tab, and the 11200 Coupon Rate, Current Yield, YTM, and Market Price for Discount Bond tab. Also, take a look at the Immersive Reader tool. Practice problems typically in the text area too, with the same name, same number, but with transcripts. Transcripts that can be translated into multiple languages, either listened to or read in them. Information on the left-hand side related to a bond outstanding, remembering that when we're investing in bonds, we can basically think of them as us loaning money to the issuer of the bond, that being typically a government or a corporation, in exchange for basically rent on that money, that being a series of interest payments typically, as well as a face amount that we're going to receive at the end, which you can think of as, in essence, a return on the principal, a return on the original loan amount if it was issued at par at the face amount. However, we could have situations where the bond is issued either at a premium or a discount, in this case at a premium. So we got the par value on the left-hand side. This is the amount that we're going to receive at maturity, the $1,000, the annual interest payments. So we're not getting them semi-annual, we're getting interest payments, in essence, rent on the money that we are loaning, in essence, at $120 on an annual basis until maturity, which is going to be in 8 years. The market price, what we're actually paying for the bond, $1,400. That being higher than the par value of the bond, which means that we're buying this at a premium. So we can calculate the rates then on the left-hand side. The coupon rate could be calculated as the 120. That's the annual payments that we're going to get for the bond. And then we're going to be dividing that by the 1,000. That will then give us the 12% coupon rate. So if they were given the coupon rate, we could take then the 1,000 times the 0.12 to calculate the coupon payment, which in this case is a yearly payment of 120 as opposed to semi-annual. The current yield then, we're going to take that 120 that we're going to be receiving, the annual payments that we're going to get, and compare that not to the par value, but to the market price, which this time is higher than the par value or the face value of the bond, to get kind of a somewhat crude, back of the envelope, quick calculation for our annual yield or current yield that we can then use and compare possibly to other investments, although it's not perfect because we're really only comparing the price that we're paying to the return we're getting in 1 year. But that's a little bit more complex given the fact that we have those payments happening for 8 years, and we also paid more than the amount that we're going to receive at the maturity of the bond after 8 years of the 1,000. So this calculation was the 120 divided by 1,400, the amount that we pay for the bonds, giving us the 8.57. So we might want to calculate then the yield to maturity, which is kind of like the market rate of the bond. We're going to do this a couple different ways. Remember that you might understand how to calculate the bond price if you had the market rate, the yield to maturity, which would be the present value of the stream of payments, interest payments, and the present value of the face amount, the amount that you would receive at the end or maturity of the bond, which is the $1,000. So adding those up, if we knew the market price, if we can discount those back at the market price, would get us to the 1,400. One way you can do that in Excel and kind of back into this, the other way you can do it is use the rate function, which we will do. But if you don't know that, you can use kind of a goal seek function to basically do these two calculations based on a yield to maturity that you would guess, and then use Excel to kind of use an algebraic type of approach, solving for the unknown, solving for X here. But instead of doing it with algebra, you tell Excel, do a trial and error method, use goal seek to figure whatever this needs to be to get the end result here to be what we know it should be, 1,400 market price. So if you were to think about it that way, you can calculate the present value of the interest payments, which would be the rate. The rate would be this one that we don't know, but we would be using that cell at first, which will eventually be that 5.65, comma, number of periods would be the 8 years until maturity, comma, the payment, would be the 120 coupon payment. Discounting that annuity back would give us the 756. If we took the present value of the face amount, the rate, once again, this amount, comma, number of periods would be 8 years, comma, comma, because it's not an annuity. Present value, the future value, the amount we're going to get at maturity, 1,000. That would give us the 644. Adding those up would give us the bond price. If it didn't add up to 1,400, both those calculations being dependent upon this percent, we can ask Excel to then change this percent to whatever it needs to be to make that bond price 1,400. That's a useful tool to just understand, know about. We could also, of course, noting that these two calculations, we used the rate. So the rate is the function that we might be able to apply here. So we can use the rate function to get to that number as well. So we could say the rate function would be the number of periods. The number of periods would be 8, comma, the payment would be the 120. The present value would be then the current market price. It would have to be negative 1,400 because that's the amount we're paying out at this point. And then the future value would be the amount we get at maturity, the 1,000. That should also give us that the 5.65. Now note that if you knew this information over here, the market price, the par value, the annual interest payments, the maturity, and you used this calculation, the rate calculation, to figure the market rate, the yield to maturity, then I would double check that, right? I would use that number to figure this 5.65 and then use that to get back to my bond price. So then I would solve for the bond price using this rate, present valuing, using that 5.65, which we just talked about here, and then double check that you get back to the bond price just to get a better understanding, making sure that I'm understanding going back and forth on that calculation. You can also break this out, which is again a great tool to do, by breaking these series of payments out on an annual basis. Remember that the bond is a nice tool to use for present value calculations because you have these two streams of payment. One is an annuity, a nice neat annuity. The next is that one payment we're going to get at the end, which we can then basically calculate using these two functions and add them together. But if they weren't quite so neat, in a situation like a budget or something like that, you might have cash flows that are happening out into the future, which are not consistent or not uniform in a nice, neat annuity, for example. And in that case, you can always just basically break out your future cash flows on a year-by-year basis or period-by-period basis, and then present value them. And it's really good conceptually to do that because then you hopefully get a better conceptual idea of what is happening, and that always helps you to kind of understand and possibly be able to make better connections and make better decisions. So if we were to say that the interest payments that we have in the future, if we mapped them out, we would get $120 each year for 8 years, which would total up to $960 through the 8-year time period that we would get. We'd get the face amount back at the end of the maturity at the end of 8 years in this case. If I look at the cash flow on a period by period, in this case year by year basis, we'd get 120 each year until year 8, where we would get 1,000 plus 120 or 1,120. If we discount each year back each period, we would take that 120 discounted back at the rate of the 5.65%, and then we would bring it back 1 year. So the rate 5.65, number of periods 1, and then we're not doing a payment because it's not an annuity. The future value would be the 120. If I discounted this 120 back 2 years at the rate of the 5.65, we would get the 108. If I discount this 120 back 3 years at the rate of 5.65, we're going to get the 102, and on until year 8, where we've got that lump sum payment because we're receiving the face amount at the maturity at that point. So if I discount that back, then I get the 722, discounting 8 years at the rate of 5.65. And that, once again, if I add that up, should give us that 1,400. Adding these numbers up, that series up, we get the bond price, adding the 144, the 108, the 102, and so on up to the 277. So it's useful to be able to imagine this calculation here as well. Also, just realize that when we look at the rates, the coupon rate, we're getting paid the 12% on the coupon rate, and the market rate is at the 5.65. So meaning people on the market, basically what that means is that other investments of a similar nature are paying something less, getting a lesser yield, which means that these bond payments at 12% are better. We can't change the coupon rate on the bond if it had already been issued, for example, if it's already on the market. And therefore, the thing that we can change is how much we're going to sell the bond for. And that's why we're adjusting the price, in this case, increasing the price to account for the fact that the bond is paying out a coupon of 12% and the market rate for similar bonds or similar investments is at the 5.65. And therefore, the market is willing to pay a premium for the bonds, in this case, $1,400, as opposed to the price of the $1,000. If the company was issuing the bonds and they're turning it around quickly and issuing them quickly, they would try to issue the bonds, you would think, for the market rate, which would be, in this case, the market rate of the 5.65, and then you can issue the bonds not at a premium or a discount. But as time passes, once the bonds are created, the thing that you can change is not the coupon rate at that point in time, but the price at that point in time. Now note that if you do these in Excel, you can put this data on the left-hand side, and you can then adjust this data and make it a premium, make it a discount, and see what the impacts will be on your rates and your present value calculations, and just get a better understanding of how bonds work, how present value calculations work, and so on.